The dollar doesn't have to collapse for your life to change. It only has to stop being needed as much. And that shift is already happening, quietly, in places you never see, in spreadsheets you never read, in contracts you'll never touch. Because de-dollarization isn't one headline. It's not a flag-raising moment where the world announces we're done with the dollar. That's not how power moves. That's not how capital moves. It happens in the plumbing first. Trade invoices, settlement rails, reserve allocations, collateral agreements, tiny decisions repeated 1,000 times that turn into a chain reaction. And here's the part most people get wrong. They think the dollar is the first domino. It's not. The first thing that breaks is the system around it. The machinery that makes dollar assets liquid, trusted, effortless to use anywhere on earth. When that machinery starts to grind, everything else starts to reprice. Interest rates, housing, stocks, jobs, your savings, your purchasing power. Not next decade. In real time. Now, I know what you're thinking. This sounds like conspiracy content. No, this is documented behavior. Public reserve data, treasury auction results, central bank balance sheets, cross-border settlement shifts. You can verify it yourself. The smart money has been preparing for this for years, not with speeches, but with positioning. Quietly rotating, quietly hedging, quietly building exit stocks. So the only question you should be asking is not, is de-dollarization real? The question is, when the chain reaction accelerates, what breaks first? Is it the bond market? Is it the funding markets? Is it trade settlement? Is it inflation? Because whichever link snaps first will pull the next one with it. And by the end of this video, you're going to know the order, you're going to know the warning signs, and you're going to know what to do before the people around you even realize the game has changed. The reason most people can't see de-dollarization clearly is because they're looking for a political announcement instead of a financial footprint. They're waiting for a press conference. But money doesn't move that way. Money moves through documents, through filings, through settlement data, through reserve reports that almost nobody reads because they're boring and because the implications are terrifying. So let's put a hard boundary around what we're doing here. This is not a "the world is ending" video. This is not a prediction built on vibes. This is a mechanical analysis of how the global dollar system actually functions and what happens when the incentives change. You can verify every layer of this in public sources. Central banks publish reserve composition. Treasury auctions publish who's buying, what maturities are clearing, and at what yield. The BIS tracks cross-border banking flows. The IMF tracks global debt and FX reserve allocation. Payment and messaging systems publish volumes and regional shifts. Even corporate reports show when multinationals start hedging differently, borrowing differently, settling differently. None of this is hidden. It's just ignored. And here's the key. De-dollarization is not a vote against America. It's a risk management response to one simple reality. The dollar system forces the rest of the world to hold liabilities that can be created infinitely, while their own costs, their own energy, their own food, their own political stability remain finite. When that imbalance gets large enough, the rational move is to reduce dependency. Not eliminate it overnight, reduce it at the margin. One contract here, one swap line there, one reserve adjustment, one commodity deal settled outside the dollar. And those small changes don't look dramatic until you add them up. That's why the chain reaction matters, because the first break is rarely obvious. It's a spread widening, a funding cost creeping up, a treasury auction that clears a little uglier than expected, a central bank quietly choosing shorter duration, a trade partner settling in something else just to avoid sanctions risk. So in the next part, I'm going to give you the simplest model possible for this entire process. 4 links, 1 chain. And once you see it, you won't be able to unsee what's already starting. Most people hear de-dollarization and they imagine one simple thing: countries selling dollars. That's not the system. That's the headline version. The real system is layered, and that's why the chain reaction is so dangerous. Because it can start in one layer while the others still look fine. And by the time the public notices, the stress has already migrated. So let's define it in a way you can actually use. Think of the dollar system like a global operating system with 5 main functions. The first is pricing. A huge portion of global commodities and trade contracts are priced in dollars, even when neither side is American. The second is settlement. Even if a deal is priced in dollars, it still has to be paid, cleared, and finalized through banks and rails that touch the dollar ecosystem. The third is reserves. Central banks hold dollars and treasuries not because they love America, but because they need liquid assets that can be sold in a crisis. The fourth is collateral. Treasuries aren't just investments. They're the foundation stone used to secure borrowing everywhere. And the fifth is funding. The world borrows and lends in dollars constantly through swaps, repo markets, bank credit, and corporate debt structures that depend on cheap, reliable dollar access. Now here's the key. De-dollarization can mean slippage in any one of those functions. A country settling more trade in local currency doesn't instantly end reserve status. A central bank buying more gold doesn't instantly crash treasuries. A corporate issuing debt in euros doesn't instantly kill the dollar. But each of these is a small reduction in dependence, and those reductions compound. And when the dependency drops, the recycling loop weakens. Less trade settled in dollars means less structural demand for dollars. Less demand means fewer surplus dollars flowing back into treasuries. Fewer buyers means higher yields. Higher yields means stress in funding markets. Stress in funding markets forces liquidation. Liquidation hits asset prices. That's the chain. So when we ask what breaks first, we're not guessing. We're identifying which layer is most fragile, which layer transmits stress fastest, and which layer institutions will protect last. And once you see that order, you'll understand why the first crack rarely looks like a collapse. It looks like a spread, a cost, a warning sign nobody on TV can explain. Here's the framework, and once you understand it, you'll stop asking, is de-dollarization happening? And you'll start watching the only question that matters: where does the stress show up first? This chain reaction has 4 links. 4. Because that's how the dollar system transmits pressure from the outside world into your daily life. Step by step, whether you're paying attention or not. The first link is trade settlement. Not headlines, not speeches, invoices. When do countries start settling even a small percentage of energy, metals, food, or industrial goods outside the dollar? That's the first crack. It doesn't look dramatic. It looks like a new payment option, a bilateral arrangement, a quiet "we'll accept your currency." But what it really is reduced forced demand for dollars at the margin. The second link is reserve recycling. This is the part nobody explains. For decades, the machine worked like this. The world earned dollars through trade and parked those dollars back into US treasuries. That kept US borrowing cheap and kept the system stable. When trade settlement shifts even slightly, or when geopolitical risk rises, reserve managers change behavior. They don't announce it. They adjust maturity. They hedge. They buy less. That's when the bond market starts feeling different. Not crashing, just heavier, like it needs more effort to move. The third link is collateral and funding. This is where things break fast. Because treasuries aren't just an investment, they're the grease in the gears. They're used to secure loans, to back trades, to keep global financing liquid. If confidence in that collateral changes, even a little, haircuts rise, funding costs spike, and forced selling begins. That's when healthy markets become fragile markets overnight. And the fourth link is domestic consequences. That's the part you actually feel. Higher interest expenses, higher mortgage rates, lower asset prices, bank stress, inflation that doesn't cool the way people expect, political pressure that forces bad choices. This is when people finally wake up. But it's always late, because the first 3 links snapped quietly. Now, we're going to test this chain against history, because this is not theory. This is how reserve systems actually die. And then I'll show you which link is cracking right now. In the early 1900s, Britain didn't wake up one morning to an announcement that the pound was finished. What happened first was quieter, and that's the point. The first crack wasn't a currency collapse. It was trade and settlement behavior changing under pressure. While the public still believed the old system was permanent. Before the First World War, the pound sterling wasn't just respected, it was embedded. Global shipping contracts, commodity invoices, insurance, trade finance, all ran through London's banking network. If you were moving goods across oceans, you were touching sterling one way or another. That's what reserve dominance really looks like. Not pride, plumbing. Then war arrived, and with war came a different kind of cost. Britain didn't just spend money, it reorganized the entire economy around survival. Imports surged, gold moved, controls tightened, and slowly, merchants and counterparties began making rational adjustments. They looked for settlement that was safer, easier, less politically constrained. Not because they hated Britain, because they hated uncertainty. Here's the mechanism. When trade partners sense that a currency's future purchasing power and convertibility are less stable, they don't wait for collapse. They change the invoice. They add clauses. They shorten payment terms. They demand different settlement options. They diversify the units of account. And each one of those is tiny. Each one looks like a one-off. Until it ISN single quotes T. Britain still had an empire. Britain still had a navy. Britain still had prestige. But the trade link was weakening. And once that happens, the recycling machine starts to sputter. Fewer trade flows settled in your currency means fewer external actors forced to hold it. Fewer forced holders means less automatic support. And what does the public see during this phase? Almost nothing. No dramatic headlines. No reserve status revoked. They see normal life with a little more friction, a little more rationing, a little more strain, a little more borrowing. And that's why it works. The first break is subtle enough that you can ignore it, right up until the stress shows up somewhere you can't ignore, like the bond market, like funding costs, like inflation that doesn't behave. That's link one. Trade settlement doesn't vanish. It starts slipping, quietly. Then all at once, everyone realizes the system they depended on has alternatives. After trade settlement starts slipping, the next link that weakens is the one that kept the entire dollar and bond machine looking effortless for decades: reserve recycling. This is where empires don't collapse in the movies. They get heavier. They get more expensive to finance. And the public usually has no idea why. Here's what reserve recycling really is. The outside world runs surpluses, earns the dominant currency, and then parks those surpluses back into the dominant empire's government debt. That flow is the hidden subsidy. It keeps interest rates lower than they should be. It keeps deficits fundable without immediate pain. It lets politicians promise everything at once, because the bill is quietly financed by foreign balance sheets. And when that recycling slows, you don't see it as a dramatic sell-off at first. You see it as weak demand. You see it as buyers asking for higher yields. You see it as auctions clearing a little uglier. You see it as a shift to shorter maturities because foreign holders don't want duration risk anymore. You see it as more hedging because holding your debt starts to feel less like reserves and more like exposure. This is exactly what happened when Britain's position began to erode after the world wars. The empire still existed. The institutions still functioned. London still mattered. But the financial math changed. Britain needed constant external financing, and the rest of the world became less willing to provide it on generous terms because they could see the trajectory: rising debt, rising social costs, rising geopolitical uncertainty, and a currency that had to defend an image of stability with fewer real reserves behind it. So Britain did what every overstretched reserve issuer eventually does. It leaned harder on internal financing, more domestic absorption, more controls, more pressure on the system to hold government paper, not because it was attractive, but because it was necessary. That's the moment the reserve currency stops being a privilege and starts becoming a burden. And once it becomes a burden, the chain reaction speeds up because the bond market doesn't care about patriotic stories. It only cares about risk, return, and whether the next buyer will be there. Now we get to the part almost nobody understands because it's invisible until it's on fire. The funding and collateral layer is where modern financial systems actually break first. Not in the grocery store, not on the evening news, but in the plumbing that keeps trillions moving smoothly every day. Here's the reality. Global finance doesn't run on cash. It runs on confidence in collateral. And for the last 80 years, the cleanest, most accepted collateral on earth has been US Treasuries. They're pledged, rehypothecated, repoed, swapped, and used as the foundation for leverage that most people don't even know exists. When markets are calm, this looks like efficiency. When markets get stressed, it becomes a trap, because the moment counterparties start questioning collateral quality or liquidity, or future purchasing power, the rules change instantly. Haircuts rise. Margin requirements jump. Funding costs spike. The same asset that was treated like cash yesterday suddenly requires more collateral today. And that one small change forces selling. Because leverage only works when financing is cheap and stable. When it isn't, positions unwind whether the holder wants to unwind them or not. This is why the first fracture often shows up as weird behavior in rates markets. Spreads that shouldn't move start moving. Repo rates get jumpy. Cross-currency basis widens, meaning the world is paying more to access dollars. Banks get cautious. Liquidity disappears exactly where you assumed it was infinite. And then, Because everyone is using the same collateral, the stress becomes synchronized. Stocks fall, bonds fall, real estate stalls, credit freezes. People call it a black swan. It's not. It's mechanics. And here's the brutal part. Policymakers usually respond by trying to patch the plumbing with more liquidity, more guarantees, more interventions. But interventions signal fragility. And fragility changes behavior. Foreign holders hedge harder. Institutions shorten duration. Counterparties demand higher returns. The system becomes more expensive to run. That's link 3. Funding and collateral don't break with a speech. They break with a spread, a haircut, a margin call. And once that starts, the chain reaction doesn't ask for permission. It accelerates. Right now, what you're watching is not a rebellion against the dollar. It's something much more rational and much more dangerous. It's redundancy being built into the global system. Because for most of the post-war era, there was no backup plan. If you wanted to trade, you touched dollars. If you wanted to settle, you touched dollar rails. If you wanted reserves, you held treasuries. If you wanted collateral, you pledged treasuries. And if you wanted funding, you borrowed in dollars whether it made sense for you or not. That's what dominance really is. It's not popularity. It's dependence. But dependence creates a single point of failure. And every serious institution on earth has been quietly reducing single points of failure. Ever since the world realized that access to the dollar system could be weaponized, restricted, frozen, or made politically conditional. Once that happens, the incentives change permanently. Nobody needs to defeat the dollar. They only need to make sure they can function without it when it matters. So countries start signing bilateral settlement deals. Central banks start accumulating alternatives, not because they think the dollar dies tomorrow, but because they want optionality. Commodity producers start exploring multiple currencies. Banks expand swap lines. Payment systems multiply. Supply chains regionalize. The whole world begins behaving like a company that just realized its one critical supplier might not always deliver. And that's the chain reaction. It doesn't require a dramatic sell-off. It requires thousands of small decisions that slowly reduce structural dollar demand. At first, it's invisible. Then it shows up as odd bond market behavior. Then it shows up as higher funding costs. Then it shows up in domestic politics because the privilege of cheap financing begins to fade. So now we're going to do something most people never do. We're going to stop talking about de-dollarization like it's a headline, and we're going to measure it like it's a system, link by link. Because once you see which link is weakening the fastest, you'll understand what breaks first. And you'll understand why the first break won't look like a collapse. It will look like a routine day in markets, with one number that suddenly doesn't make sense anymore. Even if you ignore every speech, every summit, every headline, you can still see link 1 weakening in the simplest place possible. How trade is getting settled. Because the dollar's first line of defense has never been trust. It's been habit. It's been default. To countries that don't even like America still price contracts in dollars, settle in dollars, and hold dollars between payments because it's easier than building their own system. That's not loyalty. That's convenience. But convenience breaks the moment it becomes costly, the moment sanctions risk rises, the moment correspondent banking gets restricted, the moment FX volatility makes dollar settlement unpredictable, the moment dollar funding gets tighter and suddenly the safe option comes with hidden fees, delays, and political exposure. So what do rational actors do? They don't declare war on the dollar. They add options. They write contracts with alternative settlement clauses. They start netting trade in local currency where possible. They use swap lines to bypass the need to touch dollars for every transaction. They route payments through new rails. And at first, it looks tiny. It looks like edge case behavior. It looks like a few bilateral deals that don't matter. But that's exactly how the chain reaction starts. Link 1 doesn't snap in half. It slips, it bleeds, it loses percentage points. And the world doesn't need to replace the dollar to damage the dollar. It just needs to reduce structural demand enough that the recycling machine stops running smoothly. Because every barrel of oil, every shipment of copper, every cargo of grain that settles outside the dollar is one less forced dollar purchase, one less need to hold dollars between invoices, one less pool of surplus dollars searching for risk-free treasuries. And that's where it gets dangerous. People think trade settlement is symbolic. It's not. It's flow. It's oxygen. It's the constant background demand that made dollar dominance feel natural. So when you see more trade finding ways around the dollar, even at the margins, You're not watching politics. You're watching the first link of the chain loosen. And once that link loosens enough, link 2 starts to strain. Not because anyone announced a new world order, but because the math of flows quietly changed. When link 1 starts slipping, link 2 is where the system begins to feel strain, because link 2 is the recycling engine that financed the entire era of effortless American borrowing. For decades, the cycle was simple. The world sold goods, earned dollars, and then did something almost automatic with those dollars. They parked them in US treasuries, not because treasuries were the highest return, but because they were liquid, politically neutral enough, and treated as the closest thing to cash the planet had. That recycling kept US interest rates lower than they should have been. It absorbed deficits that would have crushed any other country. It made the dollar system look self-sustaining. But when reserve managers start changing behavior, it doesn't look like panic. It looks like risk management. They shorten maturities because they don't want duration risk. They hedge currency exposure because they don't want to be trapped in a falling unit of account. They diversify into gold, into other sovereign bonds, into infrastructure, into anything that reduces single point of failure risk. And the key is, they do it quietly, methodically, over years. And that's why people miss it. They keep waiting for the dramatic headline, "Foreigners dump treasuries." That's not how it happens. What happens is worse because it's slower. Demand erodes. Auctions clear at slightly higher yields. The term premium creeps up. The buyer mix shifts from external surplus holders to domestic balance sheets and policy-linked entities. That's when the financing starts becoming circular. And once financing becomes circular, you're no longer benefiting from the world's savings. You're leaning on your own system to fund your own promises, which means higher rates or more monetization. Either way, the cost of running the empire rises. This is the moment the bond market becomes the pressure gauge, not because the dollar vanishes, but because the world stops treating your debt as the default destination for their surplus. And when that assumption dies, even slowly, everything priced off risk-free begins to reprice with it.